Hey traders and investors, welcome back to another stock market video covering what is coming up in the week ahead. In this video, we'll be taking a look at the broader stock market as well as some stocks that I'm watching in this never-ending melt-up market. If you've been watching my videos recently, you know I've pointed this out, but the stock market feels like it goes up every single day. And believe it or not, it could keep doing this. This is actually not that out of the ordinary. Once you kind of get into grind mode, the stock market can go up for many, many days in a row. Of course, there comes a point where it tips over and pulls back, in which point I think there are some better opportunities out there. But in the meantime, what do we do with this market? Taking a look at the SPY daily chart, what we can see is this past week was a really nice week for stocks. We did break through those prior highs. We actually had some nice gains on the week. RSI is looking a little bit stretched to the upside, but I do think it's fair to say that bulls are still in control of this market. From a higher time frame perspective, looking at like the weekly chart, you can see that we had confidently broke through those pre-April sell-offs. That level of resistance has been completely broken. We had a true V-shaped bottom and now have extended past those levels. In my personal opinion, I've been saying this for a little while, I think there is better risk to reward if we can get some sort of a pullback. Now, the problem is you may not get that kind of pullback. Stocks have been very stretched to the upside. So what do you do in this market? Well, I'll tell you what I do. And it is not always the fun answer or easy answer, but the answer that I will give you is that stocks don't go up forever. I know that is, a phenomenon. People, especially when the market has been going up all the time, they're like, hey, this thing just keeps going. Maybe I should just buy now. And while that has been a good strategy for the last few months, it's not always a great strategy to just chase the highs. In my opinion, the better route here to finding good trades and opportunities would be to wait for a pullback, especially since what we've been talking about on the channel here recently, which is the macro outlook looks a little bit bleak with weak jobs numbers and sticky inflation. I do think that this week's Fed meeting, we are very much going to get some rate cuts from the Fed. The question is, will it be a sell the news event? That is the question. And I think that there is a very big possibility of that being the case if you do see Jerome Powell kind of comment that the Fed is going to cut rates, but that it is going to sort of do so with very close eye on inflation, perhaps less cuts than what the market thinks we're going to get this year. So I do think you have the possibility of a pullback, but I do remain bullish on a higher time frame perspective. From a bigger picture, the price technicals still look very strong to the upside. Same with the QQQs, and maybe the more interesting of the list is actually the Russell, which is, in my opinion, plenty of room to continue to go higher. It's been performing well in 2025, and the question now becomes, is this a buy the dip opportunity even more so than the S&P 500? In fact, if we actually compare IWM/SPY, what we can see here is that we have broken this sort of downward, and what we're doing here, by the way, is we're looking at the small cap index, IWM ETF, versus the S&P 500 weighted ETF, which is the SPY. We've seen this thing move lower, consolidate sideways, and now actually starting to break out of consolidation. In my opinion, this is something that could be sustainable, especially if we are entering into a paradigm where rate cuts are back on the table. I actually like small caps from a risk to reward basis better than the S&P 500 itself. So if you do get a bit more of a pullback on this chart, perhaps this is an opportunity to look to engage more on the small caps side of things. I think there is, like I said, more potential reward there, and we also know that small caps are priced much cheaper than the S&P 500, which is very expensive and very highly valued. Now, again, for good reason. The AI tech companies of the world are generating massive profits, and so there's a lot of excitement around the big tech stuff. But I do like the Russell 2000 ETF on a dip as well. I do think if you get, a couple days, or even, let's say this is a red week, there may be an opportunity to come in and scoop in some lows. In fact, key area on the IWM that I'm watching going into this week would be around the 232 level. If you were to get a pullback, there could be an opportunity to maybe scoop up some long side interest rate plays, if you will, where you still are going to get rate cuts, and that could help the Russell continue to sort of have that relative strength performance versus the S&P 500. With that said, what about Qs, right? Qs broke out here. Tech stocks to me, just not as attractive personally to the IWM or to places where I think I'm going to get a little bit more value. Again, markets are very expensive right now. That's not even a up for debate. They're very pricey in terms of, I shouldn't say that, everything is up for debate, but in terms of like historical PE ratios, what bulls would say is that it's a new paradigm and that PE ratios should be much higher than they have historically, and what more traditional value sensitive people would say, hey, PE ratios at these levels are a bit concerning. The risk to reward looks not so attractive. And I fall more in the latter, to be honest. I do think that stocks look expensive. Doesn't mean they can't get more expensive or keep going higher, but I just think the risk rewards are important. Tesla. So some of you guys know I am a Tesla shareholder. We had a huge bump this past week. Very nice move to the upside on Tesla stock. So I own 400 shares of Tesla. So this was a really good week for me last week. However, we've got a situation. I also sold calls at the $355 strike price and the $400 strike price. Those go out to October 17th. So if this rally continues in Tesla shares and we push higher, then I will have officially taken profits on my 400 shares, and I think it would be somewhere around a 60% profit on my position. So if the stock keeps going higher, I am perfectly fine. This would be an incredible trade. If the stock rolls over before October 17th, which is the X date on these calls that I have sold, then what would happen is I keep the shares, and I'm also fine with that. So this is the thing about covered calls, is I've collected some nice premium the last few months for selling calls on my Tesla shares. And now that we're getting a big push to the upside, it is an opportunity for me to essentially take profits on this nice little pop. I bought Tesla down, around the lows here of these moves. In fact, let me just pull it up and show you. Okay, so here it is. I know it might be a little hard to read, so let me just read this out to you essentially. So I have Tesla shares that I bought for an average price of $235.48. I have calls, like I said. I'm sitting in very nice gains. Actually, I should take this back. Actually, if we close out all of these positions, it'll be more like a 70+% gain, which is pretty incredible. And, I'm not complaining. If I get called away, it is what it is. Obviously, if I didn't have calls sold and the stock went to 450, I would make more money, right? Because the calls sort of hedge my upside or cap my upside in exchange for the premiums that I collected. So in hindsight, shoulda, woulda, coulda just held the shares long, no calls, sold, I mean. But it is what it is. I'm actually perfectly fine if I get called away. I think that this position is something that I do want to take profits on. I've made a really nice gain in the stock. I do also see risks to the financials of Tesla. This is a stock that you're not really buying it for the financials, though. If you're somebody who likes the stock, which I've liked Tesla for years and years and years, I've done really well on Tesla stock. It is my most profitable stock I've ever traded. But I can't ignore the financials do look just really, really expensive. In all categories on the edge, on the stock box here, our tool that we use to analyze stocks, Tesla's expensive. There's no question. But again, I think I go back to my point is if you like the stock a significant amount, what you probably would respond to and point to is that, well, robotaxi, well, all these new futuristic, Optimus bots and all these things that they're going to build, they're not yet priced into the financials, or the financials don't take those things into account, which I think is perfectly fair. But for my style, I don't want to have overly large exposure to a company that does not have kind of like tangible numbers yet. And I know that is, not for everybody, right? Some people prefer to invest in stuff that's going to have huge profits potentially tomorrow. But to me, that is leaning heavily on the speculative side. And so while I do like the idea of keeping some Tesla in my portfolio, and I probably will buy it again if we get some dips in the market, this was a trade for me. When I bought this, it was because I thought that the whole, tariff tantrum stuff that was going on was overblown. And I ended up being correct about that. We have not seen, at least up to this point, maybe something changes, but we haven't seen dramatic, inflation and countries essentially, completely closing their borders off to the U.S. We haven't seen that, right? So we've seen from that 238 price that I purchased the stock at, Tesla, which is a very high risk stock that cratered in all of that, right? And this was also the Elon Musk drama too as well. But during all that, right, we did see actually the Elon Musk drama was like over here, but the stock sold heavily off the idea that tariffs were coming and that EV sales in Europe were down and the numbers, the financials looked terrible. So I bought the stock. It was more of a trade, and I've done really well with it. Where the stock has appreciated under my in my portfolio, but it has also given me many chances to sell calls against my position, collecting a lot of income between this period. So I'm happy to say goodbye to Tesla. I shouldn't say happy. I'll say see you later for Tesla, because I will probably buy it again if you do get a downturn in the stock. Apple shares also rebounding here a little bit. Didn't love, or the market didn't really love their announcement of those of the thinner iPhone plus the Duolingo killer. If you know what I'm talking about, those the AirPod 3s, I think. Which make it so that you can listen and real-time translate people in other languages, which is pretty cool. But Duolingo stock, of course, in response to that, not particularly loving that. This is a super volatile company. It's an interesting one, though. Anyways, not the subject of today. Let's also take a look at some other big movers on Friday. We did have AMD up. Apple, Palantir had a really nice rebound here this past week. And we also have Uber back towards those highs. I am a shareholder of Uber. I like Uber quite a bit. If we take a look at like the financials of Uber, it might be getting a little bit more expensive now, but no, I mean, you can still see a lot of our metrics here look good for Uber. Like Uber to me is still kind of a buy. You have a PE ratio around a forward PE 21.7, trailing 12-month PE 16. I mean, this is, to me, they have good earnings growth, good revenue growth. To me, Uber is a stock that I really like and like the idea of holding for the longer term, as long as, financials continue to look good. And I think that we are set to head to new highs in Uber. I do like the stock quite a bit. You have resistance overhead here, right around this, just shy of the $100 mark. So I'd be curious to see if we can get a pop through those levels, at which point any sort of pullback to me would be maybe a momentum buy for Uber. Again, quite a nice stock and one that I own some shares in myself. Also, of course, Nvidia. Still shy of those highs. You guys may have known if you've been listening to my my channel here that I sold my Nvidia shares, and I think I sold them around here. So I'm, still sitting on the sidelines watching Nvidia. If we do get a market turn down or a pullback in the market, Nvidia would probably be top of my list to pick up shares in once more. If I take a look at the financials of Nvidia, and by the way, the tool that I'm using, this stock analyzer, it's one of many tools within the Stock Box, which is our product here that we build at my company, A1 Trading, for stock trading and investing. If you're interested in using these tools that I do to scan financials, to scan macro data, dividends, technicals, sentiment, financials, and much, much more, check it out down below in the description. You can also, for a limited time, if you are stuck here with me into the video about 13 minutes, it's currently 40% off. If you use the promo code in the description down below, YTVIP, plug it in and at your checkout point, and you'll get 40% off the tool for a limited time. So there you go. Okay, so Nvidia, a little bit of a mixed sentiment here. Total score of +4 on the stock box. If I take a look at the top stocks, here's the thing, right? As a stock trader or investor, you have options. You have a lot of options. That's the cool thing about stock market world, is you have a lot of different stocks to look at. And so while Nvidia is a stock that I really like, there's other stuff that I like more right now. And believe it or not, it's actually, going to be things like Amazon that I'd pick over Nvidia, or even things like Abbott Laboratories or United Health actually looks really good. So if I pull up UNH, right? So this is, by the way, I breezed over this. This is the top stocks algorithm. It is a algorithm that we've developed here behind the scenes on this software to look at a collection of technical readings, sentiment readings, and financial readings. Across all of this, it then scores them and gives me a watch list of stocks that look attractive. So what I'm looking for is a combination of price momentum, sentiment that looks good, so institutional activity buying the stock, as well as analysts giving it a good rating, financial readings looking good. I'm looking for that combination. I want everything to sort of align, at which point I'm looking for the stock to move higher. UNH is sort of checking most boxes for me. We have some momentum to the upside. Financials look relatively good. So let's pull it up. UNH, again, really interesting break of this 315, 320 range, right? This was, if I zoom out here, you can see we had the big dump on those, on this kind of the bad news that has been hitting the stock like crazy here, but the financials still have looked intact for a little while. However, if you've been listening, my primary thing that I've been looking for with United Health, UNH, I wanted to see some momentum pick up in the stock. So I am looking for, at this point, momentum seems to have turned to the upside. I'd love to see this thing give me a little bit of a pullback. UNH at 315, if we were to get it 314, actually looks like a buy to me. So I'm going to look for that. If the market gives me a little bit of a pullback, bringing things like UNH down with it, that may actually be a buy opportunity for me from a trading perspective. So I like UNH quite a bit to the upside, and we'll keep an eye on that one. We also have NEE. If you've been watching, I also picked up shares in NEE. Looking okay on this one, right? So I'm about break even if I were to pull up my shares of, let's just pull this up, NEE. So I do have NextEra Energy. About break even on it. I'm up 1.29% on this. But I do think that we have upside for the utility stocks, which is where I parked some capital there. Also in XEL, XL Energy, another one. This one's actually doing better for me. So if I pull up XEL, you can see we're doing okay, up 3% on this one. So I do like some of the utility stocks, a little bit more defensive in nature, and I do think that you are going to get rate cuts. So that does sort of align with my bias. Is I think the macro looks a little rough out there. I think stocks could pull back. And so if they do pull back, I have a shopping list kind of at the ready, again, sort of generated for me through the top stocks page. But I'm watching for pullbacks. Let's keep going. So if I'm taking a look at Amazon, for example, if we pull up AMZN, Amazon looks great to me if you do continue to see a little bit more of a pullback. So I know I keep saying that, but it is a patience game. It's kind of like, fishing, right? You got to like sit there and let your line out for a little while before you catch something. So for me, that means waiting for pullbacks in the broader market. And so it doesn't come every day, it doesn't come every week, and there is patience involved in trading, and that's really key. So I'm waiting for these stocks to give me a chance. Like, for example, if Amazon makes a move back down to 221 or 212, those would be areas where I may take a stab at going long the stock. I actually do like Amazon where it currently sits. I don't think it's incredibly expensive relative to its own history. Let's take a look at AMZN here, just for example. Here's Amazon, right? So Amazon, if we take a look at its PE ratio 30, still an expensive PE ratio in absolute terms, but relative to its 3-year average, Amazon looks okay. I'm sorry, the 34.7 is their PE ratio. 30 is their forward PE ratio. But relative to their 3-year averages, you can see both are relatively cheap. Now, against their industry, Amazon is expensive. Makes sense, right? When you're comparing against other similar kind of shipping companies, like, for example, like UPS is another hot topic. Stock has gotten absolutely killed. And I've mentioned that I'm just not a huge fan of UPS, because when we look at the UPS chart, right? So Amazon's like near all-time highs, right? Look at, you have here UPS, and it's, getting crushed. It's at multi-year lows. And so here's the thing. Yes, the forward PE ratio looks great relative to 3-year average, but the problem is you have very low earnings growth, right, relative to history. And so when we look at that number and we say, okay, stagnant growth in terms of earnings and revenues, compare that to an Amazon, and I am going to pick the Amazon, right? The Amazon's got growth. And now, of course, Amazon, it's a little bit unfair to completely compare those two things because Amazon has many businesses under their belt rather than just UPS's kind of, they do too. UPS has many things they do, but they're definitely more concentrated than Amazon, I would say. So, is my pick of the litter going to be UPS? I think that if you're a value person, if you're a dividend person, there might be some great value to pick this one up thinking, hey, they'll figure things out. If you want to stick around with the stock for a number of years and collect a dividend in the meantime, there's a strategy for that. And there's different traders and investors who like different things. What I'm looking for is a little bit more growth and momentum in terms of trades. So when it comes to a UPS getting, hit hard, again, I don't think, my personal opinion tells me if I bought some UPS, stuck it in a portfolio and waited for a long time, it's probably going to do okay. It's probably going to do fine over the longer term. I think that they probably will sort things out. But the question then becomes, am I better off buying a UPS or buying an Amazon? And for me personally, in the next 6 to 12 to 18 months, I think Amazon's probably the better buy. That is my opinion. I could be wrong, right? That's the beauty of trading and investing. The value guys could have a turn where, dividend stocks do incredible for 12 months and UPS maybe becomes a more attractive asset to the market than, the higher growth, higher, risk names like Amazon and Nvidia's and all that. So that is my opinion on that matter. But just there's different investors, different types of people, right? Some people prefer your more defensive names and some people prefer the more growthy names. Speaking of growthy names, let's talk about Robinhood. Robinhood is probably actually, let me just really quick check this. If I go to my positions and let's just filter this by, let's go, what do I want to do here? Quantity, that might get me close. So I have my silver position, which is the biggest position, but this is an active trade, like a shorter term trade. Robinhood is my biggest stock position, I believe, other than Tesla, which the thing is, Tesla is likely to get called away from me. Hood might become my biggest position in my portfolio pretty soon if I get called away from Tesla. I'm doing really well on the stock. Overall, I'm up 187%. I also have sold calls. Those calls are out to October 17th as well, as I mentioned earlier with my Tesla calls. Calls are not doing phenomenal. The stock did pop here after I sold these calls. So, however, I still have some room to the upside before I have to start forfeiting gains on the stock due to the calls that I shorted, right? So I have choices here. We did get a little bit of a sell-off on Friday. If you get another couple days down, I may get a chance to buy back these calls for a small profit. And if this thing continues to rip higher, I do have potential upside up to 125. Why potential upside? Well, past 125, I no longer have gains in the stock because I'm short calls at 125 for the same amount of shares that I own, right? So that's what a covered call is. You essentially cap your upside across a certain strike price in exchange for collecting a premium. So I collected premium, which, this stock offers really high premium when you sell calls on it. So I've done really well with call selling. Actually, I take that back. I've done okay on my call selling with Hood. The thing is, the stock has been an absolute rocket ship, so it's been hard to sell calls on. But this last 2 months or so, I've done pretty well with the calls. So if I can get some downside in the stock, I may look to buy back these calls for a small profit. I hope this was helpful. This is basically what I'm looking for. Remember, if you want to get access to the tools that I'm using to scan markets, we have a dividend scanner. We have so many different things that we are adding to this product here every single week. We're building a bunch of stuff. We have dividend screeners like ex-dividend date. If you are a dividend person, you might want to check out, take a look at some of there's UPS top of the list in terms of offering dividend yield here in the stocks that we watch. Really interesting just to see that. However, here's something to note, right? That payout ratio is very high, 97.3%. So they are paying out. In fact, we could just take a look at this. We could read this. Company's payout ratio is a percentage of its earnings paid out as dividends to shareholders. It's calculated by dividing. Long story short, they're paying out pretty much all of their income or all of their earnings in the form of dividends, right? So that is something to pay attention to, because if that goes up much more than 100%, oftentimes the dividend has the potential of getting cut. So yes, you've got a really high dividend here in UPS, but that could get cut. So pay attention to this. Having the right tools, again, helps you to scan these things in a closer way. Like I said earlier, if you want to get access to the tool that I'm using, it's 40% off. Click the link in the description down below this video and punch in the promo code YTVIP for that 40% off discount to Stockbox. Thank you guys so much for watching. Have a great trading week ahead.